Return on assets, ROA, return on equity, ROE. These are very important, especially when we're talking about the tanking industry we're talking about today. So return on assets, ROA, is a financial ratio that indicates how profitable a company is in relation to its total assets. It is commonly expressed as a percentage using a company's net income and average assets. So you see return on assets formula, net income divided by average total assets. A company's ROA can also indicate how well it's managing its assets to generate profits. Average ROAs can vary significantly by industry. For example, an asset-intensive company like an airline might have an ROA of 2%, while a company with fewer assets and a similar net income might have an ROA of 15. In general terms, ROA above 5% is generally considered good. An ROA above 20%, a return on assets above 20% is considered excellent. Again, it varies industry to industry, and you have to compare the other businesses within that industry to get a good gauge. But those are for the general consensus. For some gematria, we have return on assets, ROA, is a good metric, 137, English reduction, the 33rd prime. We have ROA and ROE for asset and capital heavy stocks equals 133 in English reduction. And so now getting into return on equity, ROE is the measure of a company's net income divided by its shareholders' equity. ROE is a gauge of a corporation's profitability and how efficiently it generates those profits. The higher the ROE, the better a company is at converting its equity financing into profits. A return on equity, ROE ratio of 15 to 20% is generally considered good. It's higher than the ROA, while 5% is considered low. Ideal ROE can vary by industry, with some industries considering an ROE of over 25% desirable, while others may consider over 15 exceptional. The single biggest difference between ROA and ROE is that the ROE takes into account a company's debt, while ROA doesn't. If a company doesn't have any debt, these two numbers would be the same for that company. Remember, shareholder equity equals assets minus liabilities equals the shareholder equity. So not divided. And then we got return on equity formula, ROE, net income, annual, and then the shareholder equity, which is assets minus the liabilities. Then we have, for gematria, we have return on equity, ROE, has use, 333, English ordinal, powerful, and the 117 in English reduction together. So return on equity, ROE, is an important metric for companies. Okay, they look at it. Equity is your capital, your assets, your liabilities, everything. What are you getting out of that profitability wise? And are you doing it? Are you generating net profits efficiently? So when you look at ROA and ROE, especially in asset heavy companies, capital intensive companies, industries, these are good signs, and make sure to compare them to different companies within that industry to get a gauge on where that stock you're looking at, what it's doing. Okay. And so that's what I have on ROA and ROE.